In the early hours of tomorrow morning, as trading desks across mainland China prepare to shut their terminals, and the Shanghai Gold Exchange prepares to close its doors for the longest market closure of the year, the global precious metals complex will enter what can only be described as the most precarious 8-day stretch of the entire trading calendar. This is not merely a holiday. This is not simply a pause in market activity. What begins tomorrow represents a fundamental restructuring of global liquidity dynamics, a complete removal of the single most important player in the physical precious metals market, and the creation of conditions so thin, so volatile, and so unpredictable that both historic opportunity and catastrophic risk exist in equal measure. The world's largest gold-consuming nation, the planet's dominant mining force in precious metals, the central bank that has accumulated bullion for 15 consecutive months without interruption, and the industrial powerhouse that controls nearly 2/3 of global refined silver output will simply cease to participate in the market for 8 full trading sessions. And in that vacuum, everything we understand about price discovery, about liquidity provision, about the fundamental relationship between paper contracts and physical reality will be tested in ways that few market participants are truly prepared to comprehend. What makes this particular Chinese Lunar New Year closure so extraordinarily dangerous is not the holiday itself, which occurs annually and follows a predictable pattern of reduced Asian participation. What elevates this 8-day period into something far more consequential is the collision of multiple converging forces that have created the most explosive conditions in precious metals markets since the historic events of early 2020. Consider for a moment what we are dealing with here. The COMEX silver inventory currently sits at approximately 103 million ounces of registered metal, the silver that is actually available for delivery against futures contracts. Set against this diminishing stockpile is an open interest position representing somewhere between 400 and 500 million ounces of theoretical metal obligations, contracts that theoretically could stand for delivery as we approach the March delivery window. We are precisely 12 days away from February 27th, the first notice day for March contracts, the moment when the market discovers whether those paper promises can be honored with physical reality. And we are about to navigate this critical countdown period without the participation of the single largest physical offtake market on Earth. The mathematics here are not complex, but they are deeply concerning. If we accept that the current inventory drawdown rate stands at approximately 785,000 ounces per day, a pace that has remained remarkably consistent in recent weeks, then simple arithmetic tells us that 8 days of Chinese closure will drain another 6.28 million ounces from registered stocks. By the time mainland Chinese traders return to their desks on the morning of February 24th, we could be looking at registered inventory in the mid-90s million ounce range. Add another 3 trading days until first notice, and we are staring at 93 to 94 million ounces available to satisfy delivery demands that could range anywhere from 40 million ounces, which would roughly match January's pattern, to something far more aggressive if physical buyers sense the vulnerability and decide to press their advantage. But before we can understand why the next 8 days represent such extraordinary risk, we must first appreciate the true scale of China's dominance in the precious metals complex. The Western financial media has a curious tendency to focus on London and New York when discussing gold and silver markets, treating the Shanghai exchanges as regional curiosities rather than the dominant physical pricing mechanisms they have become. This is a fundamental misunderstanding of where real metal actually trades, where actual supply meets genuine demand, and where the true price discovery process occurs when stripped of derivative complexity. China stands alone as the world's largest gold mining nation, producing approximately 370 tons of the yellow metal annually. To put that figure in perspective, this single country's output exceeds the combined production of Australia, Russia, and the United States. Every ounce of that domestic production flows into a market that remains chronically undersupplied relative to demand, absorbed by a population of over 1 billion people who view gold as the ultimate store of value, a cultural inheritance stretching back millennia. But domestic production alone cannot satisfy Chinese appetite for bullion. In 2024 and continuing through 2025, China imported over 1,000 tons of gold from international markets, making it by far the world's largest importer of the precious metal. Chinese households, Chinese jewelers, Chinese institutional investors, and increasingly the Chinese central bank have created a demand profile that simply cannot be matched anywhere else on Earth. The People's Bank of China itself has become one of the most important forces in the global gold market, extending its purchasing streak to 15 consecutive months without interruption. In January 2026 alone, the central bank added 40,000 ounces to its reserves, bringing total holdings to approximately 74.19 million ounces, roughly 238 tons of monetary gold sitting in Chinese vaults. And here is the critical strategic context that Western analysts consistently fail to appreciate. This is not speculative accumulation. This is not tactical positioning for short-term gain. This represents a fundamental restructuring of China's reserve composition, a systematic diversification away from United States Treasury securities that has seen Chinese holdings of American government debt slashed by 11% to $682 billion, while gold reserves expand in lockstep. The People's Bank understands something that too many Western investors have forgotten. In a world of competitive currency devaluation, expanding fiscal deficits, and geopolitical fragmentation, physical gold remains the only monetary asset that carries no counterparty risk. On the silver front, China's dominance is even more pronounced and strategically consequential. Chinese refineries control somewhere between 60 and 70% of global refined silver output, a concentration of critical industrial capacity that gives Beijing extraordinary leverage over a metal that has become absolutely essential to the energy transition, semiconductor manufacturing, and military technology. Most silver production arrives as a byproduct of base metal mining operations, particularly lead, zinc, and copper extraction, and China has built the refining infrastructure to process this material at scale unmatched anywhere else in the world. But here is where the story takes a darker turn for international silver consumers. On the first day of 2026, Beijing implemented new export restrictions on refined silver that fundamentally altered the global supply picture. Under the new regulations, only companies with demonstrated annual capacity exceeding 80 tons can participate in export activities. This single policy change effectively eliminated hundreds of smaller refiners from the international supply chain, concentrating export privileges among a handful of major state-connected enterprises while ensuring that an ever larger share of Chinese silver production remains within domestic borders. The implications of this policy shift cannot be overstated. China is simultaneously dominating global silver refining capacity while restricting the flow of finished product to international markets. They are hoarding silver domestically while tightening the valve on exports. And they are doing this at precisely the moment when industrial silver demand from solar panel manufacturers, electronics producers, and electric vehicle battery makers is accelerating at unprecedented rates. The West has built an energy transition strategy that depends on silver supply chains controlled by a strategic competitor who has made abundantly clear that domestic requirements will take priority over international commitments. This brings us to the immediate crisis: what happens when you remove this dominant force from the market for 8 consecutive trading days? The answer is deceptively simple but operationally catastrophic. Liquidity evaporates. The Shanghai Gold Exchange accounts for a massive proportion of global physical gold trading volume, representing genuine transactions between producers, refiners, fabricators, and end consumers. When these markets close, price discovery shifts westward to London and New York, but here is the critical distinction that too few market participants appreciate. London and New York are primarily paper markets. The COMEX Futures Exchange trades derivatives. The LBMA operates through forwards and over-the-counter instruments. These are claims on metal, promises of delivery, financial obligations that may or may not be backed by physical reality. Physical buyers in Asia, the actual consumers of gold and silver for jewelry, industrial applications, and investment purposes, cannot participate when Shanghai closes. This creates an immediate divergence between paper price and physical value, a gap that can widen dramatically during periods of stress. The operational consequences manifest immediately in spread widths. Under normal market conditions with deep liquidity and active participation across all major trading centers, the bid-ask spread on gold might range from $1 to $2 per ounce. During Chinese Lunar New Year, when Asian liquidity disappears entirely, these spreads can widen to $5, $10, or even more dollars per ounce. Silver spreads that normally measure in dimes can expand to 50 cents or more per ounce. This is not an academic concern. This represents real cost, real slippage, and real risk for anyone attempting to execute transactions during the holiday period. But the more dangerous dynamic involves the relationship between order flow and price movement in thin liquidity conditions. In a normal market with deep participation, a $50 million sell order might move gold prices $5. The abundant liquidity absorbs the flow. Multiple counterparties compete to take the other side, and price impact remains modest. In a thin market where liquidity has evaporated, that same $50 million order can move gold $20 or $30 because there simply are not enough buyers willing to absorb the selling pressure at current prices. The algorithms that dominate modern markets are programmed to detect these liquidity conditions and respond accordingly. They identify thin order books and pile onto directional moves, amplifying momentum in either direction. Stop losses trigger in cascades. Margin calls force liquidations. What begins as normal position adjustment becomes a self-reinforcing spiral that feeds on its own momentum. We witnessed exactly this dynamic just 3 weeks ago on January 30th, when precious metals markets experienced what can only be described as the most catastrophic single-session decline in modern history. Silver opened the day trading around $115 per ounce. By the time the session concluded, prices had collapsed to $71, a 35% decline in a single trading day that exceeded in magnitude even the notorious Hunt Brothers crash of 1980. Gold fell 12% in the same session, the largest daily percentage decline since the 1980s, a move that seemed impossible in a market that had been rallying steadily on the back of central bank accumulation and safe haven demand. The mainstream financial narrative attributed this collapse to the nomination of Kevin Walsh as Federal Reserve Chair, suggesting that his perceived hawkish orientation triggered a reassessment of rate cut expectations. But this explanation fails to account for the mechanical reality of what actually occurred in those chaotic hours. The true cause was the deadly combination of thin liquidity and forced liquidations operating in a feedback loop that overwhelmed all normal price discovery mechanisms. The CME Group, which operates the COMEX exchange, raised margin requirements on gold from 6% to 8%, and on silver from 11% to 15%. This seemingly technical adjustment had immediate and devastating consequences for leveraged speculators who suddenly faced the choice between posting massive additional capital or closing their positions. Most chose to close, and they all chose to close at the same time, in the same direction, during Asian trading hours when liquidity was already compromised because Chinese traders were preparing for the very Lunar New Year holiday that now looms before us. The crash began in Asian trading and accelerated through London. By the time New York opened for business, the damage was catastrophic. 1.8 billion ounces of paper silver traded on COMEX that day, a volume figure that exceeds 2 full years of global mine production. And the vast majority of those contracts were opened and closed within the same session, a pattern of trading activity that suggests coordinated exploitation rather than genuine price discovery. Dump paper, crash the price, exit with profits. The mechanism is as old as financial markets themselves, but the speed and scale of modern algorithmic trading has amplified these dynamics to levels that would have been impossible to imagine even a decade ago. Now we stand at the threshold of an 8-day period where Asian liquidity will not simply be reduced, but entirely absent. This is not January 30th, where Chinese participation was diminished as traders prepared for the holiday. This is complete and total removal of the world's largest physical precious metals market from the pricing equation for more than a full trading week. If someone possessing sufficient capital and market position wished to trigger another crash, these are precisely the conditions that would facilitate such an operation. Thin liquidity, minimal participation, algorithmic dominance, and no physical backstop from the world's largest bullion-consuming market. But here's where the story becomes more complex, because the same liquidity conditions that enable crash scenarios also enable explosive rallies. If physical buyers decide that this is their opportunity to accumulate before March delivery pressure intensifies, they can spike prices with equal ease. A $100 million buy order in a thin market can move silver $10 in minutes rather than the single dollar move that might occur under normal liquidity conditions. We witnessed exactly this dynamic last Friday when the Consumer Price Index data printed softer than expected. Silver surged from $74 to $79 per ounce, a 7% move in 4 hours of trading. This was not the result of massive buying volume. This occurred because liquidity was already thinning as traders squared positions ahead of the weekend and the holiday, and the algorithmic response to a macro catalyst overwhelmed the limited selling interest available at prevailing prices. Let us now walk through exactly what closes when, because understanding the precise contours of the liquidity vacuum is essential for anyone attempting to navigate the coming week. Tomorrow, Monday, February 16th, represents Chinese Lunar New Year Eve. The Shanghai Stock Exchange will close for the day. The Shanghai Gold Exchange will close. Chinese commodity markets will shut down. Hong Kong will operate on a half-day schedule. Singapore will similarly conduct half-day trading sessions. This represents the final gasp of Asian liquidity before the complete blackout begins. For those watching closely, tomorrow's abbreviated session offers critical intelligence about how Chinese traders chose to position before surrendering the market to Western participants for 8 days. If gold spikes above 5,700 or crashes below 4,980 during those early hours, that is Chinese money making its final statement before the closure. Pay particular attention to the Shanghai premium over London spot prices. If Chinese gold trades at a $20 or $30 premium to international benchmarks, it signals that domestic demand remains extraordinarily strong, and physical buyers are bidding aggressively before losing access to the market. If Shanghai trades at a discount, it suggests selling pressure into the holiday. Tuesday, February 17th, marks the official beginning of Chinese Lunar New Year, the Year of the Horse, and the commencement of the full market closure that extends through Monday, February 23rd. That is 8 consecutive trading days without mainland Chinese participation. Hong Kong markets remain fully closed Tuesday through Thursday, February 17th through 19th. Singapore closes Tuesday and Wednesday before reopening Thursday. The practical consequence is that from Tuesday morning through the following Monday, every precious metals transaction that occurs anywhere in the world will take place without the direct participation of the largest physical market on Earth. Wednesday, February 18th brings the release of FOMC minutes from the Federal Reserve's most recent policy meeting. Under normal market conditions, these minutes might move gold $10 to $20, depending on whether they reveal hawkish or dovish sentiment among committee members. In the current liquidity environment, the same release could trigger $50 to $100 moves as algorithms detect the macro catalyst and find insufficient counterparty interest to absorb directional flow. If the minutes reveal division between hawks and doves, or if they hint at a faster path to rate cuts than markets currently expect, precious metals could rally sharply on thin volume. If the minutes suggest the Fed remains committed to restrictive policy despite softening inflation data, the selling pressure could overwhelm the limited buying interest available during the holiday. Thursday, February 19th brings initial jobless claims data, a weekly release that normally generates modest market response, but takes on outsized importance when liquidity has evaporated. An unexpected spike in claims signals labor market deterioration, supporting the narrative of economic weakness that should accelerate Fed rate cuts and benefit precious metals. A drop in claims signals continued economic resilience, potentially supporting the dollar and pressuring gold and silver. The critical insight is that every move will be exaggerated by 2 to 3 times normal magnitude because there is no Asian liquidity available to absorb directional flow. Friday, February 20th marks the reopening of Hong Kong markets after the 3-day closure for Lunar New Year. This session provides the first feedback from Asia on the price action that occurred during the blackout period. If Hong Kong traders validate the prior week's Western pricing, either by supporting rally levels or not aggressively selling into any weakness, it confirms that Asian sentiment aligns with the direction established in thin liquidity. If Hong Kong opens and immediately trades aggressively against the prior week's moves, it signals that Asian physical buyers disagree with Western paper markets and are expressing that disagreement through order flow. This divergence has historically presaged significant trend reversals in precious metals. The final weekend before Chinese markets reopen, Saturday and Sunday, February 21st and 22nd, offers no trading but should be used for intensive preparation. Check the COMEX inventory reports for any unusual drawdowns or deposits. Examine open interest changes to understand whether speculative positions are building or unwinding. Survey physical premiums at major dealers to assess whether spreads are widening, indicating demand exceeds supply, or tightening, suggesting supply is catching up to demand. These data points will inform positioning for the critical final days before March delivery. Monday, February 23rd represents the last day of Chinese market closure, and by this point we stand just 4 days from February 27th, first notice day. The pressure will be building toward the delivery resolution. Watch for aggressive position squaring as traders who do not wish to hold exposure through first notice day close March contracts and roll into May or July. If open interest drops sharply during this session, it suggests the squeeze narrative is weakening as speculative positions exit. If open interest holds steady or increases, the delivery pressure remains intense and the potential for disorderly resolution increases. Tuesday, February 24th, brings the moment of truth as mainland Chinese markets reopen and participants who have been absent for 8 full sessions return to discover where prices have moved in their absence. If Chinese buyers come back aggressively bidding for physical metal, it validates the bull case and could trigger fear of missing out rally dynamics that carry prices sharply higher. If Chinese traders return and immediately begin selling, it signals that the holiday period gave them time to reassess valuations, and they have concluded that current prices at $1,500 gold and $78 silver do not represent attractive entry points. This session will likely set the tone for the critical Wednesday through Friday stretch leading into First Notice Day. The COMEX inventory situation deserves particular attention because this crisis is developing in parallel with the Lunar New Year liquidity drain. 103 million ounces of registered silver available for delivery against open interest, representing 400 to 500 million ounces of contractual obligations. The daily drawdown rate of 785,000 ounces has remained remarkably consistent, suggesting systematic physical offtake that is not responsive to price fluctuations. Do the math on what remains after 8 days of continued drainage during Chinese absence, then project forward through First Notice Day, and the registered inventory figure begins to look genuinely precarious. If delivery demands in March match the 40 to 50 million ounce pattern established in January, COMEX fulfills its obligations, but is left with barely 43 to 54 million ounces for April delivery month. That is still a crisis level that calls into question the exchange's ability to function as a physical delivery mechanism. But if delivery demands escalate to 80 or 100 million ounces because physical buyers smell blood in the water and decide to press their advantage, COMEX simply cannot deliver. The system breaks. Default occurs not through counterparty failure, but through physical impossibility. The wild card in this equation is JP Morgan, which issued 99% of January silver deliveries, 8.1 million ounces, through 1,624 contracts. One single bank provided essentially the entire physical supply to satisfy delivery demands. That is not a free market functioning normally. That is controlled rationing by a single dominant institution managing inventory to prevent chaotic default. But what happens if March delivery demands reach 80 million ounces? Can JP Morgan source that quantity of physical metal in a market where China has been absent for 8 days, where physical premiums are elevated globally, and where the entire supply chain is stressed to breaking points? Nobody knows the answer. That uncertainty is precisely what makes February 27th the event that truly matters in this calendar. 3 scenarios present themselves for the coming week, each carrying roughly equal probability given the uncertainty inherent in thin liquidity environments. The first scenario involves orderly consolidation, gold trading in a range between $4,950 and $5,100, silver holding between $76 and $81. Volume remains light, volatility elevated but manageable. The FOMC minutes prove neutral. Jobless claims print in line with expectations. Hong Kong validates the range when it reopens Friday. China returns Tuesday without disrupting the established trend. We drift into First Notice Day without drama, allowing the March delivery process to unfold without acute stress. This represents the base case, carrying perhaps 40% probability. The second scenario involves bullish breakout, carrying Friday's CPI-driven momentum through the holiday period. Gold breaks above 5,100 and tests 5,150 to 5,200. Silver reclaims its 50-day exponential moving average at $81 and pushes toward 84 or 85. Physical buyers front-run the March delivery squeeze, accumulating ahead of First Notice Day. FOMC minutes hint at faster rate cuts. Jobless claims spike unexpectedly. Real yields fall further. Hong Kong returns bullish. China reopens and resumes buying. We enter First Notice Day with strong momentum and elevated delivery risk. Probability approximately 30%. The third scenario involves flash crash redux, the thin liquidity environment being exploited exactly as it was on January 30th. Someone with sufficient position size dumps aggressively during Asian hours when there is no bid available. Algorithms detect the move and pile on. Stop losses cascade. Margin calls trigger forced liquidations across the speculative complex. Gold breaks 4,900 and tests 4,850 or lower. Silver crashes to $72 or $74 or worse. It is January 30th playing out in slow motion over 8 days instead of a single catastrophic session. FOMC minutes prove hawkish. Jobs data comes in strong. The dollar rallies. Hong Kong sells off when it reopens. China returns and provides no support. We enter First Notice Day with weak hands shaken out and open interest collapsing. Probability approximately 30%. The setup is genuinely binary. Either liquidity holds and we consolidate through a frustrating range-bound week, or liquidity breaks and we witness violence in either direction. There is no comfortable middle ground when participation is this thin and the stakes are this high. Friday's CPI rally demonstrated that macro catalysts remain operative, that cooling inflation combined with rate cut hopes produces immediate precious metals strength. But one good session does not erase the trauma of 30% silver drawdowns or the fact that we experienced the worst crash in precious metals history just 3 weeks ago. The scars from January 30th have not healed. The structural vulnerabilities that enabled that crash remain fully intact. Survive this week, preserve capital, maintain flexibility. China reopens Tuesday, February 24th. First notice day arrives Friday, February 27th. Those are the dates that matter. Those are the moments when the real story will be written in order flow and delivery notices, rather than speculation and narrative. Until then, exercise extreme caution, reduce risk, widen protective stops, trade smaller sizes, watch every session with vigilance because in thin liquidity conditions, everything can change in minutes. A single large order arriving in a market with no counterparty depth can move prices further in 5 minutes than they normally move in 5 days. That is the reality of trading without China. That is the environment we enter tomorrow morning. The next 8 days will test the precious metals market in ways that few participants have adequately prepared for. What emerges on the other side, whether crash or rally or grinding consolidation, will set the stage for the March delivery drama that represents the true climax of this extraordinary period in precious metals history. The only certainty is uncertainty itself. The only edge is survival. The only strategy that makes sense is preservation of capital and optionality until genuine price discovery returns with Chinese participation. The clock is ticking. Tomorrow morning, the Shanghai Gold Exchange closes its doors, and we discover whether this market can function without its most important participant.